Hello and welcome to Finance RM. In this lesson, we will talk about bonds. So, firstly, what is the purpose of bonds? A bond is essentially a loan agreement between an issuer or borrower and an investor, lender. Instead of going to a bank for financing, governments and corporations issue bonds to raise money directly from the public or institutions. Core features of a bond include the principal, which is the face value or par, and the coupon, which is the interest payment or fixed or variable interest paid to the bondholder, usually semi or annual, and the amount borrowed, typically $1,000 per bond unit. This is what the issuer repays at maturity. The maturity date is the date when the issuer repays the principal, as maturities can be short term, as less than 3 years, medium term, 3 to 10 years, or long term, 10 plus years. Issuers could be governments, municipalities, corporations, or supranational institutions like the World Bank. And marketability, as bonds can be bought and sold after issuance, making them tradable securities. Why do issuers issue bonds? Governments fund deficits, infrastructure, war financing, or public projects. Then, corporations finance expansions, mergers, acquisitions, or refinance old debt, and municipalities for building schools, highways, or hospitals. Why investors should buy bonds? So, investors should buy bonds for steady income stream, lower risk than stocks, especially for government bonds, portfolio diversification, and potential tax advantages such as municipal bonds. Next, moving on to the types of bonds. Then there is bonds that come in a wide variety, categorized by issuer structure, coupon style, and special features. By the issuer, government bonds, such as US Treasuries, which are most secure, highly liquid. There's the gilts, bonds, JGPs, and sovereign risk varies, as Argentina's bonds are much riskier than US's Treasuries. The municipal bonds issued by the US or states and cities are often tax exempt on interest. Then there's the corporate bonds, which are issued by companies, higher yield than government bonds due to default risk. Supranational bonds are issued by institutions like IMF, World Bank, or European Investment Bank. And there's the coupon structure, which is very floating rate notes, and fixed rate bonds, which is paying a fixed coupon until maturity, and coupons linked to benchmarks such as LIBOR or SOFR. The zero coupon bonds are no coupons sold at a discount and redeemed at par. Step up bonds, which are very detailed and are convertible and can be converted into company stocks. Callable bonds, which issuers can repay early if interest rate drops, and puttable bonds, which holders can demand early repayment. Perpetual bonds, no maturity as they pay coupons indefinitely, and inflation-linked bonds, such as TIPS in the US, as adjust coupon and principal for inflation. And by risk level, the investment grade BBB or higher is safe, and rated BB plus or lower is risky and high yield. Bond valuation and mechanics. Our bond investors need to know how much a bond is worth and when they're earning. The bond pricing is a bond's price is the present value of all cash flows, coupon, and principal. The yield measures is the current yield, where the current yield is the annual coupon divided by the price. The yield to maturity discount rate, that makes PV of cash flow equal to the price. And yield to call is yield if issuer redeems early. Duration and convexity is the duration measured by bond sensitivity to interest rates, and convexity is adjusting for duration for large interest rate changes, capturing curvature in price-yield relationship. Yield curve is plots yield versus maturities and shapes upward sloping normally, an inverted recession warning, and flat if uncertainty. The worked example would be that a bond in a 5-year market, $1,000 face value and 6% coupon, would mean a market yield of 5%, and the price about $1,043, as the premium bond, since coupon is greater than the market yield. The bond market and trading. There's the primary markets or new issues, governments which use auctions, competitive and non-competitive bidding, corporations which issue through underwriters or investment banks, private placements which sold directly to a few investors without public offering, secondary market which are after issuance, mostly OTC or over the counter. The US has TRACE system for post-trade transparency. Bid-ask spreads or highly liquid treasuries may have 1 to 2 cent spreads. Illiquid corporations may have $5 plus spreads. Trading venues such as Bloomberg, Market Access, MTS for the Europe and dealer networks, and market participants such as central banks, institutional investors like mutual funds, pension funds, insurers, hedge funds such as arbitrage, relative value, and strategies, retail investors mainly through bond ETFs, funds, and global market size, which is the world bond market is about 133 trillion as of 2025, and the US alone is 50 plus trillion. Lastly, we have bonds in portfolio management. Bonds are not just income tools, they're used strategically to shape portfolio behavior. Stability and capital preservation. The treasuries and investment grade bonds provide downside protection when stocks fall, safe haven during crises, income generation, which are regular coupon payments, and attract retirees and income-focused investors. The laddering strategy, which buy bonds with staggering maturities to smooth cash flow. Matching liabilities or institutional LUDs, which is pension funds, insurance companies will buy long-term bonds to match payout obligations. Liability-driven investing or LDI, which is inflation protection, and TIPS and inflation-linked security preserve purchasing power, and real asset bonds backed by infrastructure revenues can also hedge inflation. Diversification and correlation benefits, as historically bonds have negative or low correlation with equities. And modern innovations such as bond ETFs provide retail investors with instant exposure to diversified baskets. Green bonds or ESG bonds finance climate and social projects. Smart beta fixed income funds tilt toward value, low volatility, or key factors. And the risks and challenges of bonds include the interest rate risk, where the biggest risk is investing. When the interest rates rise, bond prices fall, inverse relationship. An example, if you hold a 10-year bond paying 3% coupon and market rise to 5%, your bond is less attractive, so it drops. Longer maturity bonds are more sensitive to rate changes than shorter ones for higher duration. There's a credit and default risk, a risk that the issuer fails to make coupon or principal payments. Government bonds of developed nations, US, Germany, Japan, have near zero default risk. Corporate bonds and emerging market sovereigns carry higher default risk. Credit rating agencies such as S&P, Fitch, address, and Moody assess risks such as AAA is the safest, BBB is the lowest investment grade, and below BB is junk bonds. An example is the Lehman Brothers bonds became worthless after its 2008 bankruptcy. There's an inflation risk or purchase power risk, which is fixed coupon bonds lose real value when inflation rises. A 4% coupon may look attractive until inflation hits 6%, eroding real returns. Inflation-linked bonds hedge this risk. Liquidity risk, as some bonds trade heavily like US Treasuries, but other municipal small corporate issues may be difficult to sell quickly without a discount. Liquidity risk is higher in stressed markets, along with reinvestment risk, as coupon received may have to be reinvested at lower investment rates. There's also the call and prepayment risk, which callable bonds may be redeemed early by the issuer if interest rates dropped and investors lose out on future coupons, as well as currency, political, and regulatory risks. And a concentration risk, holding too much into one type of bond exposes investors to systemic risks in that segment. Remember that bonds are always important and classified by the issuer, coupon features, and junk. They are how they priced, yield, duration, and convexity, how they are issued, traded, and who participates, the strategies and use in investor portfolios, and the risks are all the risks in the interest rate, credit, inflation, liquidity, etc. Thank you, and remember to be smart, stay smart, and achieve your financial goals. And don't forget to drop a like on the video and subscribe to the channel. Comment any questions you have or advice for the channel.